I guess that's what we should call this, right? With myself and my good friend Imran Lakha and his brand new Options Insight T-shirt, which is very sharp. I'm still waiting to get one. I don't know when.
Sorry about that.
So Imran, we were, as we do every week, we're having a brief chat before the conversation every month. Brief conversation around what's kind of percolating here into August expiration. And we started on the topic of rates, which is a weird thing to start options expiration, but there was a bunch of movement today. You can kind of see that on the screen here, and that seemed to have shook up the market a little bit. You had a nice kind of narrative on the rate change here. So do you want to kind of just start with that, frame the macro a little bit, and then we can dive into some more of the options mechanics?
Sure. So, I mean, I think that's the main sort of thing that's been spooking markets, right, for the last couple of weeks, the move in yields. And there's been a few things that are driving those yields, right? So you had the first thing was the change in the Bank of Japan. They kind of lifted their cap on yield curve control. But they didn't just say, oh, we're lifting it from 50 straight to 100 and the market just repriced straight to 100. That would have been carnage. So instead, they said, we're going to let it slip somewhere between 50 and 100, but we're going to intervene whenever we feel like it, right? So sort of introduce volatility and confusion, but say we're not fully out of the market, but we are going to give it some room to move, okay? But what essentially happened is the market jumped by about 15, 20 basis points on Japanese 10-year. That then filtered through to the rest of the bond market and everything sold off, right? You also had the Treasury say they were going to issue a load more debt than the market was expecting. That was another reason why bonds started selling. And then also you've got a lot more people speaking up about inflation and saying, well, inflation expectations have already normalized quite a lot. Core isn't really coming down very fast. And we expect it to re-accelerate because of what oil and some of the commodities have been doing. And so people are getting concerned that, the inflation fight is still on, even though some of the headline prints over the last few months have come in light. And that's what's been driving yields. And so we've been creeping back up to these October last year highs in yields. And people are now quite scared that if we break 430 on the 10-year, then where the hell are we going, right? Some people are talking about a 5 handle, which would be pretty much carnage, I think, for the market.
And I think the way that I generally read this is it's really the rate of change that matters here, right? I mean, obviously rates are 30%, it matters, but how fast is that increase? And that is a decent segue, I think, to Jackson Hole next week. As what I wonder is, volatility is kind of elevated here. It's kind of sticky. You and I had both commented before that we're looking for the VIX to kind of really crush a little bit into expiration tomorrow. But now there's a little bit of extra bid to volatility here. The market's not wanting to catch that bid. Is the kind of thing where now we're all just got to wait for Powell to kind of give us an update next week? Is that?
Yeah, I don't know if Jackson Hole's that much of an event though, right? Because they're talking about, they're going to talk very big picture in Jackson Hole. So that's, so I'm not sure there's anything immediate that they're going to allude to or talk about in Jackson Hole. So I don't think Jackson Hole's being priced as a particular event. I just think the weakness in the market has led to a bit of a pop on VIX. The rates vol has become quite elevated relatively, right? So until rates vol calms down, I mean, VIX already has pulled back. It got to like 18.5 last week. So it has pulled back a reasonable amount. Yeah. And yet spot is still at the local lows, right? I mean, spot, I think the lows on spot were like 44.40 or something. We're only 10 points above that, right? So spot's barely budged, but vol's already retraced from 18.5 to 16 odd. I was looking for it to go sub 15 into expiry, but it doesn't look like that. It doesn't feel like that's going to happen. You need to see a bit of a pop in the market for that to happen tomorrow.
Yeah, and there, to your points, there's been a lot of hand wringing around, is this the top? Is this the end? All that. And the volatility's been very muted. And you see the bank, research come out. We're in a negative gamma regime and all these kinds of things. But our daily forecasts have been very tight, 67 to 75 basis points on a one-day range. And there have been a few instances of some pretty big intraday mean reversion, moves to kind of get us to close unchanged. But if you ultimately look at the daily changes in the market, they've been very contained. This is the 5-day return histogram here in reds over the last 5 days. So, we're not really doing very much at all. to your point, and volatility is coming down. So even though the market is down, volatility is down at the same time. And then on the point of Jackson Hole before,
screen sharing? I can't see you screen sharing.
Oh, my bad. I've been sharing a lot of screens the entire time, and
I haven't seen any of it.
Let's go back to the. I should turn the chat on because people are probably screaming at me about all this. So this is the daily return histogram here that we were talking about before, where it's vol down, market down, vol down, right? And that's sort of to your point before. Yes, S&P is down 3% ish for the month, depending on where we close today. But the VIX has also come down off those highs. This is the chart that we put in our note this morning of Jackson Hole from last year, and I think this really caught the market off guard, and I suspect that Powell probably doesn't want to do the same thing that he did last time. Don't know Powell, so that could be incorrect. And I do think, if I remember the narrative from last year, it's like it's supposed to be a non-event, and he kind of caught people off guard last year. And so, who's to say that kind of happens again? But with expiration tomorrow, as we start to kind of shift the conversation to the various expirations that we have VIX expiration tomorrow. There's a lot of size at the 15 strike puts below. We're losing about 30% of total open interest in the VIX. And what do you think? Oftentimes we have a major kind of imbalance between calls and puts, right? We had that in July options expiration as the market had rallied so much that built call positions up. In this case, that imbalance doesn't really seem to be as strong if we look at that. If we look at the breakdown, so here's the concentration of index and ETF positions, calls in orange, puts in blue. It's pretty equal. Not only is it equal or even, this expiration is much smaller than the September expiration that you can see on your screen here. So I personally don't have a strong directional lean to come out of this with. And I guess I'm just sort of looking for like volatility to loosen up or expand a little bit, right? The kind of this trading range we've been stuck in to kind of loosen up a little bit, starting with VIX expiration tomorrow. What's your sort of read here as we move forward?
So I think this setup on the VIX was similar to the one in July, where you had quite a lot of calls. You kind of had a little move up in the VIX to pump some juice into those calls again, and then as it just didn't transpire, like the big spike, all those calls get evaporated, and there's a load of VIX that comes back onto the market. And I think that was kind of what we were seeing back end of last week as the vol was reversing back down and getting hit. Now all those calls are kind of dead, right? So it's quite hard to predict what the print's going to do. I don't generally tend to try to do that, but I don't have a really strong opinion on August expiry either. Skew did get a bit pumped as the market came down. It started to pull back after CPI and PPI. Skew has started to come back a little bit. It's still in the 30th percentile, the way I look at it, 25 delta 1 month. So it has got room. So I think there's room for the market to rally. We are at the bottom of the range. I think the tech stocks lead us out of it, but we need yields to calm down, right? So if yields can pull back, and they've had an intraday reversal, you had some hot UK inflation data, yields all spiked, including the US, and then they've reversed back down, and two-year yields are down on the day. So if that does become a bit of a reversal candle and we do start to see yields come down a bit, I think that's good for equities at the margin, and I think tech will lead the way higher. We already started to see that, some of these semis names got a bit oversold like last week, which is why Nvidia was up 7% yesterday on Morgan Stanley, like saying it was a top pick or something, right?
Yeah,
all the semis names. All the semis names ripped, and that kind of shows you that these names have corrected, like Microsoft, Apple. They've all corrected quite nicely, but they're in very strong uptrends, and they just need to be the lid needs to be lifted on what's going on with yields, and then these stocks can get back into their trend, right? So for me, that's the base case that's kind of worth trying to set up for. Obviously, you need to have stops, you need to size it properly and not risk too much. But gun to my head, I'm looking for some sort of move up, say between now and middle of September, and I think you're getting an entry point here.
Yeah, I think you bring up the key point. Is this a consolidation? Was it mean reversion? That's how we've been framing it as well. You had just excess call, buying and activity that led to call skews pop and just very rich kind of upside implied volatilities. And you can really frame that just very simply, I think, through the put call ratio. You can see here's the June and July, the amount of calls we had trading was record calls, et cetera. And that's now burned off, right? We've mean reverted kind of back to something that's a little more in line with recent history. To your point before on skew coming down as well, the call skew has come down depending on instrument to instrument, but in general, call skews have come down. We have a risk reversal metric here as well, but even though stocks have come down, a lot of these names, we're not seeing like a demand for the put side, right? So we're not seeing signs that people are trying to bet that Apple's going to drop another 5 or 10%. We're not seeing people looking to really own tail risk or downside protection in any index stuff. And so from my perspective, I'm in the same camp as you that this has been a correction. I don't think we go below 4,400, and I think we probably bounce and start to move back up, particularly if the implied vol starts to come back down. So I think you and I are really in alignment on that aspect. When you look, I'm sorry, go ahead.
The one wild card is China, I guess, right? Because that's what just keeps knocking the market back down. So Chinese stocks, keep coming off. The property, they've got issues with their property sector. I had another big developer kind of defaulting recently, Country Garden. And no matter, they're not bringing out the bazooka with regards to stimulus. So you are seeing commodities a bit weak today, and you have seen Chinese stocks sell off. And Europe tends to get dragged down with it as well. So whilst I think the US market wants to rally, we're kind of not letting it right now because we've got China problems and we've got yield issues, right? If either or both of those can calm down, then I think tech in particular has another little charge. Right, but that's what we're waiting for.
Yeah, and I think it's not only tech. There's one of the things I think that you can frame from this is that we had such concentrated breadth, right? The complaint about the previous rally was it's like, look, it's 10 stocks that are meaning everything to markets, and there's other, the breadth seemed to improve, right? As we move from, hey, it's only the AI stocks that matter to, you saw maybe a little bit too much excitement in a lot of other names that were non-AI related, I guess. But that seemed to me to kind of improve breadth and be something that was a sign of more stability. This is industrials, which, the Inflation Reduction Act and the industrials have been rising because of, the stimulus, I suppose, that's getting dumped in that. This chart doesn't look all that healthy to me at the moment, but I took that as a healthier sign that things would kind of move ahead here. So when I look at the OPEX, I think we clear out some of the calls. Like there's been a fair amount of call selling, as evidenced in the chart. I don't think there's a whole lot of puts to clear out. And so all else equal, it does. I do agree with you here that the market doesn't have a reason to go down. And when you don't have a reason to go down, then upside drift, I think, naturally kind of kicks in. One of the things I want to ask you about here, we were talking recently about the kind of VIX fair value and where you should look at, where should implied volatility be. And again, there's term structure here and tenor and different things like that. But let's just focus on the kind of 30-day, kind of fair value, because, VIX seems fairly elevated today right now. And how much, anxiety is the market pricing in? If you look at the longer term history of this, the VIX tends to be about 3.5 points over 1 month S&P realized, based on some data that we put together. And if you look at realized volatility right now, 1 month is at a 9.2 and the 5-day is at a 7.3 roughly. So, there's all this anxiety around, the market's really moving. There's negative game in the market, blah, blah, blah. But 5-day realized vol is a 7 and 1 month is a 9. So do you look at this 1 month realized volatility as your barometer for where you think kind of 30-day, let's just say the VIX is for sake of argument, and so you feel like vol is rich right here?
Yes. So I don't quite look at it like that. What I do is I say, what is the 1 month implied vol? Mm-hmm. And the VIX usually trades 3.5 vols above that, let's say, right? But the spread between the 1 month implied vol for the vanilla at the money options, the spread between that and the realized, that's the juice, right? That's the risk premium. So I don't compare the VIX directly to the realized, because
Mhm.
I think the VIX is also a function of the steepness of the skew, function of the wings, things like that. So for me, the purest thing to do is to look at the at the money vol compared to the realized. Right now, index vol is realizing really, really low. So there is
Yep.
a bit of juice there for the gamma sellers, right? And then, like I say, the VIX typically just trades about 3.5, 4 vols above that 1 month implied number, right? So
Yeah.
that's how I look at it.
So
Yeah.
here that 1 month realized is a 9, 1 month implied vol. This is based on last night's close is a 13. So it's probably a little bit maybe higher based on some of the downside, but it's generally at ballpark. So we got about a 4-point spread. So,
Mhm.
from basically what you're saying is, where if we're talking horseshoes and hand grenades here, that's pretty much in line with what you'd expect.
Yeah, I think a premium, if you do it in percentage terms, so if you look at that 4 vol premium and divide that by the level of the implied vol, that's about 20%, right?
Mhm.
Ish. So yeah, to have a risk premium of about 20%, yeah, that's about right. Like if it stays there, if it stays, it usually doesn't stay there for that long. You'll probably entice more gamma sellers and you'll compress it a bit. Yeah. But that risk premium is going to often be in the kind of 10 to 20% range where implied trades over realized. Yeah.
Right. So we're really volatility is fairly valued here. So back to the, maybe that wants to induce or entice sellers, but on the flip side, there's not like this demand because people are worried about, the sky falling tomorrow, right? There's yield anxiety and whatever else, but no real sign that there's material hedging in a way that, has increased over the last couple of days, despite the market coming down.
Yeah. I mean, the question is, how sentiment did become more bullish, but how long did institutions really get? That's the question, right?
Yeah, that's a tough one to answer. I mean, depending on which bank produces the chart, people have completely, filled their
Opposite.
portfolio equity exposure back up, and then the next chart I see says, well, like everyone's bearish. So, I've yet to found like a dependable measure of that. I would assume the way that I'm thinking about it is that there was indeed a regrossing. People built into these AI narratives or whatever it may be, and then as these call implied volatilities got very rich, I think there was a lot of overriding, and that's probably a decent way to segue into some of these other products. Like we have JEPI, which is really quite interesting right now, because I would just say anecdotally on Twitter, maybe it's just feeding back because I'm paying attention to it, but there's all these people talking about overriding as income strategy and the discussions around JPI. This is the JP Morgan Call Overriding Fund. It's gaining assets. I think it's got $25 billion assets under management. And the deals with this is it overwrites up to 20% of its equity exposure, which is in about 130 different, large cap-ish stocks. Overwrites that using equity-linked notes. So the point of that is that they're overriding, but we don't know exactly how or what that exposure is, et cetera. Do you think that this call overriding will persist? Do you think there was a lot? Do you think that people took advantage? The larger institutions took advantage of that elevated call skew to, overwrite NVIDIA positions or Apple positions and things like that?
Yeah, I mean, it's pretty systematic, I think, in the institutional world to do call overwriting. So, I think it works. It has worked for a long period of time, and that's why you don't do it in your entire size, right? So that if you do get crazy moves like we saw in Nvidia, you haven't lost your entire position, right?
Yeah.
Anyone who's doing a systematic call overwriting fund is if they're smart, they're not going to overwrite their entire position, right? Because they're in the stocks because they like the stocks, right?
Yeah.
So you don't want to be like in the stocks, but then you give your whole position away 10% higher and the stock doubles because you look like an idiot, right?
Right.
So I don't think they've done that. But there's also loads of index overwriting that goes on as well, right? Which is why the index vol just trade gets crushed so much and trade at such low levels, right? But I think like the rally that we had into July, where you saw skew flatten dramatically and you saw a decent amount of upside demand in index land as well, and you saw the VIX float to the upside, I think that was kind of indicative that people didn't own the market enough, right? And so rather than being forced into the market at the highs, they would rather just buy call options, right?
I totally agree with you, and I think that's the total right way to frame. And I'm not going to bring this up on the right chart, but that's the right way to frame. I think June and July in general is you saw a lot of episodes of market up, vol up, record call volumes, and all those kinds of things. And that by and large is, I think, cooled off really over the last 2 months. So if you were fortunate enough to own those calls and those positions, I mean, do you transfer them to stock to maintain your exposure, do you think, or you just kind of say, look, I got that call right and I'm done? I mean, I would think on the institutional side, you have to maintain that exposure, right?
You have to maintain what? That you have to be long the market still. You think?
Yeah.
Or well, like I say, I think people were too underweight, and then when it became clear the recession was getting pushed out, they're like, well, are we gonna chase the market here up at the highs, or are we just gonna buy calls because they're not that expensive? So I think they bought calls. Now that the market's corrected a bit, I think part of the reason why it's not melting down is because maybe people are on the bid and happy to kind of address some of those underweights, right? And that's why we're kind of struggling to move in either direction, really. Like we are weak, but we're not crashing, right? So I just think the fundamentals look a bit better than people thought at the start of the year. The economy has been more resilient. We are starting to see jobs numbers turn a little bit, but not too dramatically. So that's what I'm saying. I don't think we've seen enough yet to derail the rally, right? I think that's why I think this is still a correction. There will likely be enough bad news later down the line to derail the rally, right? And we could get something a bit more nasty. I'm just not sure I've seen it yet.
Yeah, and just touching back on the overwriting, I think there's also been a fair amount of put selling, and people are still looking for the opportunity to sell elevated implied vols, and what that does in my view is, even though a lot of these bank models are saying negative gamma, and that should mean that things really have to move, I think the actual gamma exposure is a lot more neutral because of the persistent put selling and even some of the call overwriting that we've gotten. Before I forget to ask, I gave you credit where credit is due. You said that after earnings, we would get a pop in correlation, which I think also is a great way to view the way that calls were bid in single stocks and the index volatility has really been reduced or sold off. We've gotten some reversion in that as well, so that maybe there's kind of an unwind of that extreme. This was going back to levels that weren't seen since 2017.
Yeah, that wasn't me really predicting. That was just, it's quite mechanical, right? Because the way that correlation is calculated, it is just, think of it like a ratio between the index vol and the single stock vol. So when you get correlation go quite far down into earnings, it's because earnings vol is refusing to come down because no one wants to sell the earnings gamma, right? And index vol is your funding leg. So people sell the index so they can hold on to the single names. As soon as the earnings season is done, all those earnings vols that are trading rich are going to have to reset lower. So that ratio, then that balance, even if the index vol doesn't move, that ratio adjusts because those single stock vols have to reset lower. And that's why your correlation goes up. So it's a very mechanical thing. It wasn't me predicting and being a genius. It was just kind of understanding what that number represents and how it's calculated. And just knowing that every earnings season, you get these vol resets after earnings made me think that that was going to be the case.
Yeah, and it leads me to my question here, because you think kind of tech could catch a bid again, and some of that single stock call froth has now come off. Do you see this sort of rebuilding? I guess are we going to go back to the way things were August, June, July, or do you think that kind of extreme, now that a lot of these stocks are up 20-30%? Do you think we're really unlikely to see those kind of extremes that we were seeing, right? Because I feel like these were really extended.
Sorry. I don't think they rip as hard as they did. I just think they might revisit near the highs again, right? So, because I'm quite a subscriber to the Elliott wave theory, right, on technical analysis. So the ridiculous move that we got from April into July in some of these tech names is very much a third wave type move in Elliott wave, right? Which is a very impulsive, very sharp move. It's very rare for that to then be reversed and then just never retest or never go near it again, right? So I don't think the market's going to ultimately top on that type of move. So I think you're going to get another leg higher, whether it's the conclusive leg higher, and then we do get a more meaningful sell-off, who knows? But I think that's why it's my base case, because generally the market's not done yet. When you get that type of explosive move, the market's not done yet. You normally correct that move, and then you have a final leg higher. So that's what I'd be looking for before thinking that the market might have actually topped, right?
Yeah, and I frame that as, a lot of people miss the move. They're going to take some relative downside to take the opportunity to buy that dip, and then they need to be they need to have the shakeout right before you can kind of go back down. Like I generally agree with you that nowadays we don't see that. You framed it very well at the Elliott wave, but generally you have to have a kind of a retest of dip buyers first before you kind of fill gaps, I guess, so to speak.
Yeah, because that Nvidia gap was huge, right? So
Yeah.
like people are thinking the Nvidia gap needs to close. I mean, if that gap closes, that stock is going to take a beating, right?
Yeah,
So,
100%. And
but even
earnings,
if it does,
you have to look for earnings. I mean, the sentiment for that thing has got to be very high. This is SMCI, which really had a really violent reversal after its earnings. But I also think that dip buying is true for volatility, right? If there's so many people that love to sell volatility, there's so many people that it's been so successful really since March in particular, that if you get a little bit of volatility premium in there, you got to believe there's a lot of people are going to want to take their shot at selling that again, right? And in the same way of maybe buying the high in Nvidia, you sell you sell volatility at the wrong time. Or squash it.
Someone's asking, isn't seasonality bearish in August Sep? So that's an interesting question, because if you take the seasonality, I saw a good chart put out by Nomura, I think it was.
Yeah,
you take the seasonality, you take the whole seasonality, yes. But if you only take the years that were a better fit on the VIX to say this year, then you've actually got the seasonality suggesting that you get a last dip in vol before you rally into September, October time, right? So it depends on what seasonality you want to look at, right? But you can take the sample that is a better fit and better correlated to this year and this year's price action on the VIX, and you'd actually see seasonality actually for the rest of August and into early Sep is actually for vol to go down, and for the market to go higher potentially.
Yeah, I'm doing an incredible injustice to this because I don't have my drawing tool is. But to your point, like we had a couple of really nasty, August years, right? But in general, and what the analogy I think is interesting is 2017 on this, because we had the August pop in August of 2017. There was a volatility pop, and it was after that we set the all-time low. I think in realized volatility was like a 3.5. But there's a seasonality to this on the webinar we were just doing. We called it kind of an echo, right? That seems to fade into end of Q3, early Q4 in volatility. So that is kind of my favorite view of what's going to happen here, which kind of falls in line with thinking that the market may stage another rally here, that you kind of hit this ultimate low in realized, or all of it really drains out into the end of Q4, and then you got to get the end of your hedges on and things like that. So maybe volatility rebuilds a little bit. Does this kind of link more to the sentiment that you're trying to express here to Mr. Ho-Ho's question, or?
Yeah, exactly. I was just answering.
I understand my lines are really bad, and you probably aren't agreeing with my lines, but you get the idea.
Yeah. I was just trying to address his question on seasonality because it's true. Like some people are saying that seasonality is for vol to go higher now, and whilst generally September, October is often a spike in vol, I'm talking about in the really near term for the next sort of month. I think there's a window for markets to bounce and vol probably to continue coming lower. And also you got the summer factor, right? You've got people on holiday. No one really wants to do anything. Once you get back from Labor Day, then maybe people will want to do something again. But you've got 2 to 3 weeks before that, right?
And I also think that, almost in a way, you need a little bit of movement up in volatility for that final wave to come in, and really push it down, right? Because what's going to incentivize people to really want to come out and put any kind of size on it, when we're already at such lows in volatility coming into this. So if we get a little bit of a bid, then you kind of maybe get that extra size that wants to come in and give it the final offing, so to speak, into that October sort of time frame. Definitely interesting to see, but that would in theory correlate with higher equities into that Q3 time frame. So there is that. Making sure I don't have any lingering questions that I missed here. As far one of the other things that I want to touch on here, I don't know if you have a view on this. We flagged, and we've been talking a lot about the zero DTE thing, and a lot of people are just tired of talking about zero DTE, but weird things keep happening, and so we keep talking about it and keep bringing it up. On your screen here, if I zoom in just a little bit, is zero DTE in the SPX contracts itself. And, these products launched in late 2022, and you can see that immediately zero DTE volumes kind of elevated into this roughly 45% range, as you can see in white here on your screen. And then something strange happened at the start of August. As you can see here, there's been a new sort of threshold or new, mean, so to speak, I guess, in zero DTE, wherein we actually hit a record high last Thursday of 56% of SPX volume was zero DTE. But you can see here what I'm talking about, this kind of sustained elevation, so to speak, in volumes, in zero DTE volumes. And there's been a lot of unique reversals in the market with very heavy zero DTE flows. Do you have, and feel free to take a pass on this because I know this is a curveball question that you probably weren't expecting, but do you have any kind of insights on this? I don't. I've been racking my brain of what would have changed.
So this is the percentage of total S&P volume that is zero DTE. That's what we're talking about.
Correct. So this is telling you 55% of SPX volume on this day was tied to zero DTE. Now, I will tell you off the top that overall SPX options volume have not materially shifted. So my initial thought was, hey, everyone on vacation these last 2 weeks, and so we're just seeing like stable zero DTE, but all other volumes have declined. But this does not appear to really be that kind of phenomenon.
That is interesting. I mean, I would say, my understanding from people I've spoken to and kind of watching what's going on is that a large amount of the zero DTE volume is gamma selling via multi-leg structures like iron condors, and it's tranched such that they do it multiple times throughout the day. So they are slicing and dicing. So they kind of follow the market around and do some more condor. I don't know how, I have no idea how they do it, but let's say in the first 2 hours, wherever the market goes, every 15 minutes, every half an hour, whatever, I'm going to do a tranche of zero DTE iron condors. So I'm going to end up scattering those iron condors around where the market goes in the first couple of hours, right? And then I don't know whether they unwind them or throughout the day, later on in the day, they unwind them or whatever. But this is a gamma selling strategy, right? It is compressing the one-day VIX. It is supplying a load of gamma to the street, and the street isn't making any money off that gamma, which is why I realize vol is so low. So it's it makes sense that if we're in a quiet environment and those strategies are working and they're making money, then they will do more of it, right? They might do more because their AUM's going up because they're making money, right? So it wouldn't surprise me if the percentage of that activity goes up as those strategies work, right? If the market suddenly becomes more volatile again and those strategies are actually not making any money, then I'd expect that number to shrink and go down again. But,
yeah,
so
I'd agree with you. It seems like some kind of new flow is unlocked. My thought was that realized volatility did come up a little bit, right? And implieds did come up a little bit in August, kind of after the Fitch downgrade and some Treasury, waves and whatever it is. Like volatility did increase slightly. And that seemed to be the only thing that's really related to this, right? It is at August 1st that the market did come down and volatility did lift a little bit. And so that would back maybe this idea,
implied went up, but I don't think realized really did. Right? So
implied went up, yes.
So there's more juice. So if you think about it, that is saying there's more juice to extract.
A little bit extra juice, right? So that would support your theory on the sales. Yeah. And there was a note out, Bloomberg did an article about this, and they talked about the fact that more puts are now trading relative to calls over this slight time frame, which would make sense because the market's been getting weaker, so those puts would have slightly more juice to them. Even on a zero DT basis, right? Because we keep continuously kind of testing that downside. But we've also seen, big deltas in zero DT space come for sale, which what kind of, or buy. So like the zero DTs are forcing mean reversion, particularly in the afternoon. So maybe that's related to the unwinding of these condor flows that are, they're not a delta trade at the start of the day, but they're going to be a delta trade at the end of the day if you got to unwind positions that are deep in the money, right? And that is what brings that mean reversion. So it's really quite unique and quite interesting. And I feel like on one hand it's helping to aid this mean reversion. But at the second time, our gamma model, which doesn't understand zero DTE flows that initiate intraday, has still been forecasting low volatility, 60, 70 basis points a day of volatility. So it's hard to you compare those two things and say, well, it can't all be zero DT because this model that comes out overnight says that volatility should still remain fairly low. So interesting mechanics. One of the things that came up recently, Michael Burry's put position, which there's not a lot to say about that. But the funny thing here, I was laughing about it because the amount of news that has come out about this Michael Burry put position is incredible. And people jumping on him, but it's staggering to me that the number of people don't understand that in the 13Fs. I just want to do a segue on this. I don't know if you have any thoughts on his put position. I wrote about it in here. If you read a 13F, which comes out quarterly, they represent the shares as you can see here. So if you buy a one lot options, they're going to list in the 13F as 100 shares of stock. And so people are saying that he spent 90% of his exposure, or $1.6 billion on put positions, which is complete and utter nonsense. Yeah. If you do the math, which we break down right here, he probably bought about 20,000 spider puts, 20,000 QQQ puts, which is, I don't know, $10, $20 million. Maybe it depends on how far out they were, a whole bunch of other factors. But, he spent a couple of bucks, not exactly $1.6 billion. And this showed up on all of the major news wires. It's all over Twitter, that they spent all this money. And then either the guy is the dumbest guy you've ever met, or you got to brace for the hatches because he called the last, kind of downturn. I wouldn't expect you to have anything other to say on this other than a couple of giggles. Maybe you're either giggling at Michael Burry or my picture up here, one of the two. You got anything to note on this? This is kind of one of these segments that I just wanted to record while we're here, so I could put it up there as a discussion.
What it does is it just tells you how low value that those news sources are, right? If they can't even validate it to think, hang on a minute, is that the notional of the option or the premium of the option? And they just go and quote some utter rubbish that isn't true. I mean, what it says to me is how much of the other news that they spout is as ridiculous, just on different subjects that we don't know as much about. Because anyone who knows anything about options knows that that's the notion of the options, not premium, right? You see my point?
Yeah, the thing about it too is that I generally try not to speak poorly about people and things like that. And a lot of people have a model that they built, right? Maybe I don't agree with your model. Who am I to say that your model is incorrect or not correct? But this is straight up just misinterpretation of this data, which is like you can just read the definition in a dictionary and know that it is really not correct. And so that's one of the things that really frustrates me about it. And then I keep talking about it. I'd kind of forgotten the whole thing. I was going to move past it. And I went to see my neighbor yesterday. He brought up this tweet, his account. And he's like, he thinks the end is near. Did you see this? And I was like, wait a minute. But the funny thing is like you get very excited when you see $1.6 billion, and then someone goes, "Well, no, actually, you only spent 20,000." The reaction is always like, "Oh, okay." It's never like you got to flag the Armageddon stance to actually get attention on a lot of these things.
I say when you say the end is near, it's more like the end of his premium is near. Because if he did them in June, that filing was from June, and what's the market done since June, right? It's gone one way, really. So
that's exactly right. And he had covered his short earlier, said I was wrong, and he still owns a lot of stocks. So the takeaway from this, if anything, is that it seems like it's a hedge, right, against a lot of stocks here that he owns, which I know nothing really about to offer anything more on that. So that's the disclaimer. I suspect most people watching this right now already understand this, but we had to spend 2 minutes on it as a further disclaimer. So Imran, Usually at this point in the conversation, what we do is we start to shift as we approach the top of the hour here. We start to shift our conversation to the Hedge Academy, and we'd like to take some questions on options mechanics. People have certain trade ideas they're looking at. We give everyone kind of an opportunity to ask some questions here and learn a little bit more about the options complex. Just as a little bit of background in this, SpotGamma has our options education. With this guy, he's not wearing an options inside shirt or sweatshirt. We could probably update this photo to more accurately reflect the man you are today. But you provide this course, and this is a course that you gave to banks and institutions over there in the UK. And we thought it was a wonderful course. It walks everyone through the basics of what is an option all the way up into the more advanced Greeks like Vanna and Charm that you hear so much about today. And so number one, thank you for being a part of our course. But number two, we're going to open the floor here for some questions. So if you have any of those, please put them into the chat, and we will make sure to dig into that. Now, you had talked about a trade that you put on, and I wanted to start while people may be asking some questions. You called it the VIX steepener trade. And what is the kind of background on that trade? I thought it was just kind of interesting to walk through some of the mechanics. We often get people who say, hey, I want to get short vol or I want to get long vol. How do you do that if you're an average retail fellow like myself? What kind of trade would I maybe want to put on if I was looking to short, if I was looking to express a volatility, a pure volatility opinion? I don't have access to VAR swaps or anything like that. So what's a guy like me to do?
So can you bring up the website VIX Central?
Love to.
Because that's a good place to start, right? So VIX Central, this shows us what the VIX curve looks like. This is the VIX futures curve. Right. So, and you know, this kind of tends to take a uniform upward sloping shape like it has now. There's sometimes a few kinks in it here and there, but generally that's something we're tracking all the time, right? To see the shape of that curve. And what tends to happen is when the market sells off and has a wobble and vol goes up, that curve tends to flatten. And then when things normalize and go quiet again, or the fear goes away, the curve steepens again and it goes back to what we call a contango, right? So one relatively low risk way of trading and being short vol to try and play for a normalization in vol is to wait for that curve to get quite flat and then sell the front contract and buy the contract behind it, right? Which is the 1-2 month calendar basically.
So as an example, if this August, so you would sell the August in this case. I mean, expiration is tomorrow, so ignore that. But you would sell the August and then buy the September. Yeah,
so that's a trade we were telling our subs to do about a week and a half ago, right?
Yep.
And it was because we thought we saw the setup for the market to hold in there, not puke too badly, and we saw the setup for the front month to get hit. People roll exposure to the next month. And that lined up pretty well because the curve had flattened to around 0.7, right? So normally when the market sells off, the curve doesn't steepen, it kind of flattens. But that was a really nice way to express a bullish view on the market, because even though you were wrong about the market rallying, which would have made you money through the steepening, you made money anyway through the steepening, just through the fact that the VIX got hit into expiry, because the amount of flows on the VIX meant that the charm of all those upside calls that evaporated away in the last few days has meant that a load of August VIX needed to be sold, right? So that's kind of how I rationalize why the curve steepened, even though the market didn't actually manage to rally.
Right, and as we were mentioning before, realized volatility really didn't do much, and so you kind of had that as an additional weight on the complex. So that's. In what kind of a situation now? So we're going to come out of VIX expiration, right? So we would expect this to naturally flatten out, right? This curve to naturally flatten out as just the mechanics of the roll.
Well, yeah, I mean, you could just pretend August wasn't there and your front month is now September. Then that's already a much flatter curve, right? Because the difference between September and October is how much?
Not even a point.
It's 17.62 versus 18.35. There's about 70 basis points. So you're back to 70 basis points in the Sep-Oct calendar. So I'd expect that to start steepening by the end of this week. So I wouldn't be surprised.
That was my next question there,
Yeah, like if the market as long as the market doesn't puke through 4,400, I'd expect the SEP to be trading closer to 1 vol pretty soon, right?
Right, and if the market starts to rally, that'll steepen, and then naturally into expiration, because obviously, as you were mentioning, that VIX future goes to meet the VIX index price. We settle, which is going to occur tomorrow morning, and typically settlement has been a relative low in the VIX. That's what we've been seeing recently. That was the case in July, where right at the moment of settlement, that VIX index really goes down, drops, and that's where the future settles, and then we move on ahead. Cotton Dog, we all owe a debt to VIX Central. I would say so, although they're throwing some ads at me right now that what the heck's going on here? This is weird. Never mind. I'm gonna get banned on YouTube for talking about it, so I'll just move along. Johnny B says, now that hedge funds have covered their shorts and the short vol dispersion trade has run its course, do you see a high likely for the SPX to mean revert to more fundamental levels? I don't know if.
What does fundamental levels mean?
Yeah, there's a couple of Johnny B. We need to explain your question a little bit more. First, what do you feel about this idea that the short vol dispersion trade has run its course? I mean, the sort of way that, again, a retail person like myself would look at it would be through this correlation, metric just kind of shifting up. That would sort of be one indication of maybe it's running its course, but is that really the fact of the matter, right? This is a pretty basic measure of that space.
And it's still pretty low, right? Even after the bounce. I mean, look on the chart. Without that little overshoot to the downside, you're still kind of near the lows of the range in correlation, right?
Yeah, and that we talked recently to Noel Smith. It's a great video if you can go to YouTube and check that out. But he brought this up that essentially in 2017 that trade that trade worked very well into the end of the year, and you can see what I mean by that. I guess here is that you had the pop in August, but that led to lower lows going forward. So. I don't know that I keep talking about 2017. I know we're necessarily going to enter that scenario, but to your point, there's nothing that says that this has to continue up, right? We could actually just have sort of allowed people, the moves have shifted enough to allow people to put that trade back on or press, some of those bets, right?
I don't know if you remember last time we spoke, I said the biggest reason why dispersion was working was because of rates volatility, right? So
you did, right? That's exactly right.
Yeah. So I think as long as rates vol stays high, then you're going to keep seeing dispersion, right? If rates volatility goes away, then things are going to become a bit more correlated, right? But given where yields are, I would argue that rates vol is still here for a bit, right? We're either going to break to the upside or we're going to pull back from these levels, but we're probably not at a level in yields that is particularly stable. That we're just going to sit here. So that would mean rates are going to wing around, and if they wing around, then you're going to continue to see dispersion.
That was a very, very interesting insights on that. Johnny B says that he means by more fundamentals, more in line with EPS and normal multiples. I don't think the PE multiple is all that stretched right now. I was just looking at that. I think we're kind of in line with averages. Have you seen multiples lately, Imran?
I haven't, but you're talking about on an index level. But in terms of tech, obviously, a lot of tech is still on crazy multiples, right? Like anything AI related or whatever.
Yeah.
So.
So he says the XPX to mean revert to more fundamental levels. I think we're roughly at longer term averages. I don't think there's a signal that the PE is, has overshot. I could be wrong there, but I don't think we're at a crazy level of earnings. Nonstop Loss accuses that underwear ad of being my search history. I use a VPN, Nonstop Loss, so it can't be me.
There's nothing wrong with shopping for underwear, though, to be fair.
No, where else are you going to buy underwear? You're going to go to the store?
Exactly. Everyone needs underwear, right?
Oh, some funky underwear. Roulette, if I mispronounce your name, I apologize. How can they squeeze NVIDIA like they did yesterday? Is that even possible to be a gamma? What I was saying yesterday about NVIDIA, you got the stock upgrade. This was a key gamma strike here at 400. And yesterday was the largest inflows of call options that we had monitored in the last 30 days in NVIDIA. Just massive call buying there yesterday in that stock that pushed the stock, right back to this, mean reversion level 450 where there's a lot of options positioned. So now you have something interesting. And actually, Imran, I'd like to ask you about this while we have you on, and we'll probably end it with this. A lot of times now we are seeing a lot of kinks in the term structure, and I'm wondering if you could advise a couple ways to take advantage of this. This may be a little bit too close because their earnings are next week, but sometimes you'll see this is term structure here where the pre-earnings implied vol is much less than obviously earnings after, right? And sometimes this can exist far out in time where you have a few weeks to earnings and you could see kind of the peak of implied volatility or at the money implied volatility is, a month out or something like that. Are there any kind of interesting ways you have to take advantage of term structure that looks like this, where maybe you're getting away with some less stable pre-earnings implied vol versus after earnings, you're going to hold that event premium, right?
Yeah, exactly. So that's the thing. The kink in the curve always looks seducing to sell, but the truth is it doesn't really ever decay the way it's supposed to.
Right.
Because all they do is the closer you get to that date, they reinvest a lot of that theta back into the vol. So the vol just keeps going higher. So the premium of the options doesn't actually go down because they're saying, well, you're going to get a 10% gap on the day. So we can't let the straddle decay too much because the 10% gap is going to blow through the break evens of the straddle, right? So I think the implied move on Nvidia is about 10 to 11%. It's been I think it's stable at that level. I've been playing around with a few ways to try and trade it. I did a Batman structure on Nvidia the other day. Do you know what one of those is?
I read about the Batman structure in Second Leg Down, which is Hare Krishna's book. But refresh my memory.
It's basically
double condor, right?
It's like a broken wing call fly and a broken wing put fly put together, basically, right? With the same, with the same kind of starting strike, right? So if you look at the payoff profile, it kind of looks
that's where
like
you get the Batman shape.
Yeah, it looks like Batman, but I'm flying it off like with the broken wings just so that I don't.
And that's an earnings play, not a pre-earnings play.
No, so I did it on the earnings bucket in the hope that there would be some decay coming my way, right? And also that if we started to get a move pre-earnings, we'd still go towards one of the short strikes. I'd still be earning. I wouldn't move away and go to the long strike, right? So that, but actually, I've had it on for like about a week, and it's made we've gone down, we've bounced back to the middle, kind of where we started, and it's made very little premium. So it was a little tester to see if they were gonna let us earn some decay in that expiry, but they're kind of struggling to let you earn anything being short any of those 25th of August options right now. Otherwise, if you're buying options, you want to be careful about buying those earnings ones because if you get a load of choppiness on the earnings, but you kind of still mean revert and you don't end up with a massive move, all that you're going to get is a massive vol reset, and you're going to get crushed in terms of your option premium is just going to decay really hard if you hold that option over the earnings. So generally, you do want to, if you've got the stomach for it, you kind of would rather be short options into earnings.
Yeah.
It's just, you kind of got to try and find ways to stay safe, right? Because, stocks like Nvidia, I mean, it's in all our memory what it did last earnings, right? 25% on a stock that big is insane, right?
Yeah.
So I think always flying yourself off is not a bad shout, just to kind of cover your tail. But yeah, I do think generally you want to be short earnings vol.
Yeah, and the implied vol here is really elevated. I think the IV rank, our IV rank, is at a 100, so it's right up around as high as the implied vol can get for this name. And to your point, there's some memory here of that last earnings report, which was something else. So,
but based on how the other semis names have done in earnings, I mean, you've got to think it's going to be a disappointment, right?
You would think, and that's how I'm going to want to play it, is if I can just get some kind of cheap, exposure to downside, nothing. If you look at SMCI, for example, that dropped 25% or 20%, right? Or I think it was something around those lines. So, that had a really sharp drop. I think the expectations are just so high and the implied volatility is so high that you kind of get this weird like stock gaps down and vol just kind of collapses, right? And that's the kind of way that I want to position it. I just look for some kind of a lotto ticket, play around that, maybe some put flies or something like that. But I can't see how, particularly trying to be long the upside seems like the worst bet, which is probably the one that's not going to play out because I said that, because you're paying such a high level of implied volatility and these earnings have been gapping down, right? Because the expectations are so high. But, we will see what happens.
Yeah, I haven't got. Let's say I was planning to take the Batman off before the earnings numbers, but then, yeah, I mean, next week I'll evaluate what I want to do with that. But if the stock is trading anywhere near 500, I think you definitely want to have a short bias, right?
Yeah, I'm with you on that. So since we're in consensus, that means the opposite happens. I'm just kidding. I have faith in Imran. All right. So we are coming up at the top of the hour, and we thank everybody for listening to us chat. Hope you enjoyed the display of ads, etc., on our screens today. Imran, besides everyone signing up for the Options Academy right now, which you can do at academy.spotgamma.com, how can people get a hold of you? What is the best way to find out about your stuff?
Sure. So at options_insight on Twitter. We are all over Twitter on a daily basis, putting out various pieces of content and insight around what we're seeing in options. We've got a YouTube channel. We've got various services. Come and visit our website, options-insight.com, to see what we do. We are doing a webinar next Wednesday. I do these monthly live webinars where I showcase our products and walk you through a few of the trades that I've done, whether they've made money, lost money, talk you through the logic so you can see it and kind of how we think about this stuff and see if our process can kind of help you in your options trading. So that's next Wednesday, 11 a.m. Eastern. You can enroll for that on our website. So feel free, it's free. You can come and say hello, tell us what you're doing, how you like to trade, and ask me any questions you like.
Awesome. And you can reach us at spotgamma.com. You get a free 7-day trial of our daily notes, our real-time indicators, and a host of other things. So please check that out. You got free webinar from Imran, free 7-day trial from us. What more could you ask for?
It's all free. You have to pay for anything.
Just take it. All right. Thanks so much, buddy. And we will be seeing you soon.
Take care. See ya.